Hi.
Hi, how are you?
Doing great, doing great. Nice to see you.
Nice to see you as well.
I think right now what we're planning to do here is just let all the speakers trickle in. I think my co-president is not going to be able to join us until 7:30 because I think he's stuck in a meeting, but we'll do sound checks. If you have any slide decks, I know Mr. Randall wants to present off of a slideshow, so we'll test that out as well and make sure that everything's working. And we'll start the event usually about 7:30 and let people trickle in for 5 minutes and go from there.
Okay, sounds good. I'll hold tight till then.
Great. Just as a sound check, is my sound all right, or is there any feedback or anything like that?
Sounds good.
Great.
Hi, Jacob.
How you doing?
And Mrs. Walker, is it petal? Petal? How do I pronounce your
Just
first
like
name?
a flower, petal.
Petal? Okay.
Yes.
Thank you. We
Sure.
got Jacob, Petal, and the third speaker.
John McGinnis. Professor McGinnis should be coming through relatively soon.
Okay. And how's the audio and video on from y'all's perspective?
It's great on your end, yeah. Very clear.
Cool.
I like the sound system. It's a nice upgrade.
Yeah, with when you have a deep voice, you have to have a mic. I found that requirement so that you can get some depth in your voice.
Mm-hmm.
And then I'll test the screen share right now.
Sure.
You open the deck.
So see if you can do it now. I might have to make you a co-host to be able to share, but maybe not. So we'll see.
Host disabled participant screen sharing.
Okay, yes, I'll just, there we go. Okay, now it should be fine.
Is the deck moving with y'all?
Yep.
And can you see just the deck, or can you see my screen?
Just the deck.
Perfect. That'd be the most professional. All right.
So you were saying you might want to have the code up there while you're talking. How do you want to do that?
Oh, I just thought it'd be good to mention it at the end of the deck, and then as a wrap up to the event, we can send out some referral links.
Sure.
Through you. You know, we'll just send you like a quick blurb, like, hey, these are the tools that we like to use, just to help people get started if anybody's interested after the event.
Yeah, that makes sense.
Hello, John McGinnis.
Oh, Professor McGinnis, good to see you.
Fine, good. So I just wanted to make sure I was here on time. I'll just go briefly and be right back. I assume we have 2 minutes.
Mm-hmm. Yep, no problem.
Thank you.
Jacob, I'm all good on my end, so I'm going to do the same. I'll be back in a few minutes.
Yeah, we probably, just for transparency, probably won't be starting until 35-ish. Just we usually get the audience to trickle in for a little bit, but yeah.
Maybe in a few minutes, then we can review the flow.
Yeah, sure.
Awesome. I'll be right back.
Mr. Kolsha, what will be the order of speaking? What will be the order of speaking? Have you set an order?
Yeah, if you don't mind, we would actually like you to go first, if that's okay.
Fine, great. That's delightful. Thank you.
hmm I think with just with the general framing questions that you'll be answering and with your remarks, it just
Yep.
makes the most sense for you to be leading it off.
Great.
So, yep, just in general, we try to keep them to about 15 minutes each, but obviously there's no.
Yeah, I will not go beyond that.
Great, sounds good. I'm just waiting for Mr. Randall and Ms. Walker to get back before I start the webinar and let everybody trickle in. There we go. All right. Great. So just a quick review of the flow, just because Professor McGinnis asked, I think it's good to go back over. We want to start out with everyone's remarks. We try to keep them, 10 to 15 minutes, usually try to have a cap at 15 just for time's sake. The order will be Professor McGinnis, and then Mr. Randall, and finally Ms. Walker at the end. Does that sound good for everyone? Does that work? Great. Cool. After that, we'll go into a moderated discussion for about 10 minutes. That's basically, I will, basically just give you maybe 2 or 3 questions. They usually tend to be broader, just to kind of get you guys discussing amongst each other. Because if I'm assuming correctly, I don't think you guys have interfaced or met before. So usually we get some pretty interesting discussions out of that portion. And then finally, we'll have an audience Q&A for 15 or 20 minutes at the end, depending on how we get those trickling in. So as long as everybody's good with that structure, I'll go ahead and start the webinar, and we'll give everyone about 3 to 5 minutes to trickle in. And once we hit a decent number of attendees, we'll go ahead and get started. Sound good?
Great.
Great. Great. As everyone's trickling in, just so we let everybody know, we'll probably be starting in, a couple minutes, 2-3 minutes, just getting everybody some time to trickle in. All right, so now that we have a pretty good crowd of attendees already, I guess we'll go ahead and start the event right now and give everyone else the chance to trickle in as we're kind of starting with the intro. So first, welcome everybody to our event, The Future of Crypto, Decentralized Currency or Regulated Commodity. I'm Jacob Kelsch. I'm one of the two co-presidents here at the Rice Federalist Society, and on behalf of everyone involved in this panel, as well as our entire executive board, we just want to thank the speakers for their time, as well as you guys in the audience for spending your evening with us and participating in this event. Our chapter has been waiting to do a crypto event for some time now, so I'm very happy that's finally come to fruition. And I thank our speakers along with the leadership for making it happen. The broader goal for this event is to provide a comprehensive overview of some of the key elements which have made cryptocurrencies a hot topic of discussion recently. I'll now introduce you to our three speakers on the panel. So first, John McGinnis is the George C. Dix Professor of Constitutional Law at Northwestern Pritzker School of Law. Professor McGinnis clerked on the U.S. Court of Appeals for the District of Columbia. From 1987 to 1991, he was Deputy Assistant Attorney General in the Office of Legal Counsel at the Department of Justice. He is the author of Accelerating Democracy, Transforming Government Through Technology, and Originalism and the Good Constitution. He is a past winner of the Paul Bader Award given by the Federalist Society to an outstanding academic under the age of 40. He has been listed by the United States on the roster of panelists who may be called upon to decide World Trade Organization's dispute. John McGinnis is a graduate of Harvard Law, as well as Harvard College, where he was the editor of the Harvard Law Review. He also has an MA degree from Balliol College in philosophy and theology. Mr. Spencer Randall, his mission is to simplify crypto for investors, traders, and enthusiasts. He believes in disruptive innovations, a decentralized future, and that everyone with an internet connection should have access to high quality, straightforward research and market insights. As principal and co-founder of CryptoEQ, Spencer has helped thousands of digital asset investors, traders, and enthusiasts demystify the complex world of cryptocurrency. Originally from Galveston, Texas, Spencer now lives in Houston, where he holds a Bachelor of Science in Mechanical Engineering from Rice University and earned his professional engineering license from the Texas Board of Professional Engineers in 2018. Over the years, he's held leadership roles as a student mentor for the Rice Center for Engineering Leadership, a group facilitator for the Lou Lab for Innovation and Entrepreneurship, and most recently as a business mentor for the Jones Graduate School of Business. And finally, Ms. Petal Walker. She counsels banks, funds, brokers, commercial companies, exchanges, and clearinghouses, as well as innovators in the digital space, in meeting compliance obligations in a complex web of regulatory requirements. Ms. Walker rejoined WilmerHale in 2017 after serving as chief counselor for Commissioner Sharon Bowen at the CFTC, where she advised on policy and enforcement issues and led the Market Risk Advisory Committee. Ms. Walker is chair of the District of Columbia Bar Subcommittee on FinTech Regulation and Enforcement, and she's also on the board of Women in Derivatives. Ms. Walker holds a bachelor's degree in history from Yale, a master's in comparative education from Columbia, Doctors of Education from Harvard, and received her JD from Harvard as well. Mr. McGinnis will begin with a general discussion of considerations for cryptocurrencies, namely discussions of their classifications, properties, and the recent run-up in general buzz that I'm sure you all have heard in the news. We will then provide analysis of the current crypto climate from the viewpoint of crypto investment strategist, Mr. Randall, and we'll finally zoom into specific policy discussions in the realm of derivatives law as applied to cryptocurrencies, building on Ms. Walker's expertise as a former counsel at the CFTC. With that, I would like to invite Professor McGinnis to deliver his remarks.
Well, thank you so much. And I'm really delighted to talk about the cryptocurrency here. It's obviously a topic that's getting a lot of attention, not least because of its huge run up in price. I'm going to focus on Bitcoin, which is the cryptocurrency with the greatest market cap. I think it's interesting to think that when I became a member of the Federalist Society, now that was many decades ago, it would have been possible to imagine discussing the subject of cryptocurrency. And you might think that's an odd subject for the Federalist Society, but ultimately the society and the Constitution that it celebrates are concerned with relating liberty and the state. And there's no issue of modern technology more appropriate for us to consider because it's on the cutting edge where cryptocurrency is between liberty and the state, between a centralized coercive legal order and a decentralized voluntary one. So in this talk, I'm going to do three things. One, I'm going to talk about why cryptocurrency in general and Bitcoin in particular is such and ultimately maybe a threat to the centralized state. Talk about a little about the mechanics of Bitcoin, because we'll have to understand why it does instill some kind of trust. And then finally talk about what it would take for cryptocurrency to climb the rungs and actually become a currency. It's really largely an investment at the moment, but I want to discuss that at the end of the talk. So the way I'm going to begin is to contrast it with dollars, modern fiat currency, and why we trust in that. So those are quintessentially a creature of the state. In 1924, George Frederick Knapp, the father of modern monetary theory, wrote that the soul of currency is not in the material of the pieces, not in gold or silver, but in the legal ordinances that regulate their use. Knapp argued that currency must be constituted by law, since only governments can confer the requisite legitimacy to gain acceptance and trust. Thus, the underlying value of a currency is of a modern currency is intrinsically tied to a public's trust in its legal system. Yet, of course, some citizens rightly have little trust in their legal system, particularly when it comes to currency. Nation states can manipulate their currency, printing more money to fund projects for their favored supporters. The direct effects of such currency manipulation are felt most on their own people. Savings lose value as prices are driven up by inflation. Citizens become less certain of money as a store of value, and economic growth suffers. Because currency is a creature of law, my claim would be that government control over money can be a form of oppression. Venezuela, for instance, today is but the most extreme example. The recent advent of cryptocurrencies, Bitcoin chief among them, poses both a practical challenge to such monetarily oppressive regimes and a theoretical challenge to the view that only national law of currency is a necessary foundation of currency. Thus, although the creation of Bitcoin, as I'll describe it, is as impressive as a technological innovation, its real innovation is in trust, the essential characteristic of any currency that will have long-term success. Bitcoin doesn't require faith in any public institution directly, such as the Federal Reserve, a monarch, or some other central authority, but rather trust in computer logic and the effectiveness of the decentralized order that maintains it. Thus, Bitcoin is nothing less than a fundamental assault on the idea that a public law of currency is a necessary prerequisite to the modern monetary order. In fact, I'm going to claim that Bitcoin has the potential to outperform currencies produced by legal regimes as a store of value precisely because it requires no trust in a political process, but rather trust in a transparent set of rules. So let me talk, before I talk about Bitcoin, what's the basic problem for trust in fiat currencies, including our own? And the basic problem is that a legal system can't generally make the pre-commitments necessary to completely isolate the governance of the money supply from all political pressure. Bluntly, no one can insulate public law from politics. To be sure, the US dollar is the world's most trusted currency. Despite its many critics, the dollar has formed the basis for 90% of international trade over the past 30 years because companies, consumers, and central banks around the world trust in the relative stability of the Federal Reserve of the US government. Yet even the dollar has been subject to periods of severe and unexpected inflation. Since the creation of the Federal Reserve, the purchasing power of the dollar has fallen 97%. And that isn't a surprise in my view. Since the progressive era, the Federal Reserve has had other political objectives than maintaining the value of the currency, such as getting to full employment. But individuals, in contrast, have only one desire for currency they own, that it maintain its value or even go up perhaps in its value. The basic disconnect between the social objectives of fiat money in the modern era and the individual's interest, in my view, is what limits the trust that any fiat currency can enjoy. So how does Bitcoin create trust? Well, it does so in two ways. It does so by the way the transactions are verified, and by the limit of its algorithm on how many Bitcoins are created. So let me do a very brief discursus. So many of you know a lot about Bitcoin, I'm sure, in the audience, on what Bitcoin is, but you might say a cryptocurrency is a sort of contradiction in term. The one thing you know about something on a computer is it can be copied. So why don't we see a lot of double spending of Bitcoins? Why isn't that going to be a central problem for Bitcoins? Well, the way we deal with that is we have a ledger. You might think we could deal with it by just everyone having a ledger, but of course that would be extremely expensive. We can't have everyone keep a ledger. And so we have a few people who are going to keep a ledger and update the transactions. And those people are called Bitcoin miners, but that's going to take computer power. And so why are they going to do that? Well, the real genius, I think, of Bitcoin is to figure out a solution to that problem. They are actually, and I'll very much simplify, if they solve a certain problem and are randomly chosen, they're going to be paid in Bitcoin for updating that transaction. And the updating is going to require a consensus of all the miners. So people are all watching over one another, to say, as it were, to make sure that no one is double spending. And the secret here is they're being paid in Bitcoin. They're being paid in Bitcoin. And the advantage of that is, of course, they have an interest in the value of Bitcoin, because that's the coin of their realm. And the other aspect of it is that the amount of Bitcoin, I talked about subject to inflation of fiat currency, is fixed. There's going to be no more Bitcoin minute in 2140. And every year, half of the Bitcoin, the amount miners get is cut in half. Now that's all right. And I think this was the idea of those who created it, was Bitcoin's been getting up, continuing to go up in value. And so they're well recompensed. They also can be recompensed by charging for adding blocks to their ledgers as well. But that's what gives us the kind of confidence that we might not have in a modern fiat currency. So that's the idea behind the basic idea behind the trust. And note that this is a trust in a decentralized order and in the self-interest of these miners. So what is it going to need to take for Bitcoin, which has already gone way up in value, to continue not only to go up in value, but to become actually a currency? Because at the moment, Bitcoin is not a currency for reasons I'll explain. If Bitcoin succeeds as a currency, in my view, it will do so by climbing rungs left open by the frailties of fiat money. It's already gaining strength and stability, and partly by competing against these monetarily oppressive regimes that I've talked about, Venezuela, and there are others as well, where it does function somewhat as a currency, and also performing payment functions for the poor that bank regulations have made difficult. But has the potential to be more competitive and climb other rungs, because even the best currencies are subject to the kind of political risks that I described. Now, I want to say potential, because while Bitcoin is used as a currency in monetarily oppressive regimes, it does not function as a currency in more established regimes. That, of course, does not mean that people don't hold it in the United States. More and more people do hold it. Companies hold it. Tesla holds it. Other companies are starting, PayPal holds it. But most hold it for investment rather than to pay day-to-day expenses as they hold currencies. And the vast majority of people hold their cash in dollars, and even most of their assets in dollar denominations. And the reason is, for most people, Bitcoin is not yet a good store of value, and for good reason. It's too volatile compared to the dollar, and risk-averse people don't want to hold their cash and assets into things that go up and down dramatically every day. So I thought I would end by sketching what needs to happen for Bitcoin or possibly some other cryptocurrency. Bitcoin, I think, is the likeliest as a first mover advantage to gain greater market share against more mature currencies like the dollar or the euro. So here's what needs to happen. It needs to gain price. It needs to gain continue to go up in price to attract investors, but also to lessen volatility to attract people who would like to hold it for more general purposes like payment. For a currency with fixed supply, and Bitcoin has fixed supply, these two forces may sometimes be in tension, the force of going up in price and the force of being very stable. Although rampant speculation may drive up a currency's value, the inherent volatility that goes along with it can be a destabilizing for it as a currency. But I don't think this is necessarily a fatal flaw. If Bitcoin comes to enjoy a steady growth in demand, it'll be able to maintain an acceptable level of volatility while at the same time reaching a broader market. And I think there are two important conditions for this to happen. One is the easiest. There have to be continuing to be monetarily oppressive currencies to give substantial impetus to use of Bitcoin as a currency. And I'm not worried that that will be continued, but particularly because we have renewed enthusiasm for socialism in the world. And that helps us lead to monetarily oppressive currencies. But the second condition is more open-ended and I think less certain. There has to be continued strength in what I would call the Bitcoin or cryptocurrency ecosystem. Most people don't have the skills to use Bitcoin directly, and they need mechanisms to be secure in doing that. Indeed, some people who have tried to use Bitcoin directly have lost it, and there's an estimate that 20% of Bitcoin has been lost. There are these sad stories of people trying to search for their old computers, where now $20 million of Bitcoin digital keys are left. And so they need cryptocurrency wallets and exchanges like the one that's going public, for instance, soon, like Coinbase. Fortunately, these have gotten a lot more professional since the days some of them have lost hundreds of millions of dollars worth of Bitcoin. Even more importantly, there needs to be a continued growth in the markets around Bitcoin. Future and forward markets make the price discovery process more efficient. Permitting short selling also can help dampen volatility. Permitting ETFs in Bitcoin and other cryptocurrencies will allow more people to hold cryptocurrencies as part of their portfolio. That will also thicken the market and have a stabilizing effect. Now note that these wallets, these future markets, these ETFs, which are a kind of portfolio in which people can hold cryptocurrency, these, unlike Bitcoin itself, are not order without law. These are institutions regulated by our law and by our administrators. Thus, paradoxically, The success of Bitcoin may depend on the state's willingness. The state, like the United States, its willingness to apply the neutral principles of law to an innovation that may turn out to be a competitor to one of the greatest powers of the state, its fiat money. And that, I think, again shows why cryptocurrency is in the Federalist Society's wheelhouse, why it's a central focus, should be a central focus of the Federalist Society today, because its success ultimately depends on the rule of law and the constitutional respect for a new kind of property. Thanks very much.
Great, thank you so much for that for those remarks. We'll now be moving on to Mr. Spencer Randall.
Thank you, Jacob. And thank you for those opening remarks, Professor McGinnis. I've prepared a visual aid to walk you through what I think is really a primer for the crypto asset industry. I'll talk about Bitcoin and many other crypto assets. I'll also share about my background. And it's fun to reconnect with the Rice campus. It's only 10 short years ago that I was walking around on campus myself. And similar to Mr. McGinnis's opening remarks, it's hard to imagine 10 years ago that I would be speaking to an audience of Rice folks in the Federalist Society about cryptocurrency. So a little bit about my background. Born and raised in Galveston, Texas, I hold a bachelor's of mechanical engineering from Rice University. I'm a Y Combinator startup school graduate. I'm a professional engineer turned entrepreneur. So I earned my professional engineering license, but was far down the Bitcoin rabbit hole. And in 2019, I decided to pursue my true passions full-time at CryptoEQ. I've got 4 years trading and investing in crypto. So I really do live and breathe this industry. I'm the principal and co-founder of CryptoEQ.io. We're a team of about 20 folks that are dedicated and passionate about being a North Star for this industry and really a resource similar to the Morning Star of crypto that everyone out there can look to for objective, independent research and market insights on digital assets. Another professional interest of mine is giving back to the Rice community. I direct the Rice Alumni Entrepreneurs and Innovators Network. That's a network of about 200 plus business owners that are Rice alumni that are focused on peer-to-peer advisory and building community and venture together. I'd like to frame my next few slides, really this presentation, as the beginnings of what can be new financial infrastructure, running with some of the ideas that Professor McGinnis shared. Bitcoin is incredibly disruptive, and it can serve as a new base layer for a new world economy. A quick primer for some of the newcomers in the audience. Today, Bitcoin is about a $2 trillion market. Bitcoin and its other digital assets. The crypto market is about a $2 trillion market. I had to update this slide pack earlier this week because the market has been growing so rapidly. Last time I gave a presentation along these lines, it was a $1 trillion market. So we're experiencing rapid growth and price appreciation of virtually all digital assets. As far as how the market share breaks down amongst different digital assets, Bitcoin is historically about 50 to 60% of the crypto market, so about $1 trillion in market cap. Ethereum, the second largest cryptocurrency, is about 10 to 15% of the crypto market. What I like to call altcoins, things that are not Bitcoin or Ethereum, represent about 20 to 30% of the market. And then stable coins or crypto assets that are pegged to another asset, for example, the dollar, represent about 5% of the crypto market. Let's start with Bitcoin. So Bitcoin is about $1 trillion in market cap. To frame, what it is conceptually, we like to think of Bitcoin as the internet of money. It is the world's first open source, decentralized blockchain. It's the world's first unfalsifiable, digitally scarce asset. It's pseudonymous, which means that although there's public addresses that can be tracked and traced, your identity is not directly known via the public address. It's immutable, and it's censorship resistant as a store of value. It enables global permissionless peer-to-peer financial settlement and represents the true first example of global settlement across all borders without a need for a third party. I'd like to talk about some of Bitcoin's narratives because, the fact that Bitcoin has had a half dozen or so narratives in the past decade really does lead to a lot of confusion around what Bitcoin is. I'll highlight where we are today and where we started. So with Bitcoin and the Bitcoin white paper, it started as an eCash proof of concept. And the idea to create the internet of money and a peer-to-peer cash that could be used electronically. Bitcoin succeeded in that in the early days, but with the growth that it's had as a network, it's exceeded what many of the folks at CryptoEQ thought it could. It's outperformed and the demand has been incredible. And because of that, it's experienced a lot of growth challenges. So because of that, the market has really decided that today Bitcoin is a digital store of value and more of a digital gold. And that's the narrative that we see prevailing in today's world, is that Bitcoin is digital gold, and it really seems the market has decided as much. A few points about the traits of money. This is a very interesting chart. You could spend all day debating different line items in the chart and where exactly things fall, but the trend that we advocate for here is that crypto, and specifically Bitcoin, outperforms the other popular traits of money and forms of money that we know today. And it certainly outperforms as a digital gold. A little bit more about the Bitcoin as digital gold narrative, which has really exploded in popularity the past few years. So if you look at the M1 money supply, especially beginning in 2020 with the COVID-19 crisis, we started printing more money than ever before at a faster rate than ever before. And whether or not you think that we're talking about inflation, deflation, reflation, whatever economic debate you'd like to have, what we see and what I think a lot of people can agree on is that the devaluation of our purchasing power as citizens of the United States is happening faster than ever before. And so if you can agree with that statement, you start to think about how you can hedge against that risk. And that's where we think that Bitcoin as digital gold is the strongest narrative in the crypto asset industry today. I'd like to talk a little bit about the Bitcoin stock to flow model, or S2F. When I get questions about Bitcoin price, how we value Bitcoin, how we value the market, and where we think price is headed, I really like to root down in this model. It's one of my favorite models. You've got a multicolored line here that represents Bitcoin's price. The colors are tied to how far or close we are away to a halving cycle. The halving cycle is something that Professor McGinnis touched on. It has to do with mining incentives. Every 4 or so years, we halve the incentive that we use for the miners of the Bitcoin network. So if you previously were receiving about a dozen Bitcoin every block reward, think about having that and that incentive being halved every 4 or so years. What you also see on this chart in the solid line, it's got more of a stair step function. That's the ratio of stock to flow of Bitcoin. And think of stock to flow as how much Bitcoin is available in stock and supply in the market relative to the issuance of new Bitcoin. So you can see that when we have a halving event every 4 or so years, you see a sharp increase in the stock to flow ratio. And although demand may drive exuberance and drive a sharp increase in price action around Bitcoin, the stock to flow remains this stair-step function. It is the most predictable asset that we know. It's digitally created. It's driven by an algorithm. It's programmed. It does not change unless there's consensus in the network, and it has not changed since the inception of Bitcoin. So the hard cap of 21 million Bitcoin, we can have a lot of confidence that that will not change unless there's consensus in the network, and that's incredibly difficult to change at all. So we can be very confident that there will only ever be 21 million Bitcoin, and that's why we have a lot of confidence in the stock to flow model as something we can look to think about whether or not Bitcoin is overvalued or undervalued and in today's time. I'd like to shift gears and talk about another digital asset. The second digital asset by market cap is Ethereum. Ethereum is the second mover to Bitcoin's first mover, and the founder of Ethereum aimed to improve upon Bitcoin's functionality. So if Bitcoin is the internet of money, we can think of Ethereum as the evolution of the internet. It is the world's largest open source, general purpose smart contracts platform. It's the base layer for DeFi or dApps or decentralized applications and decentralized finance or DeFi. It enables a decentralized world computer and permissionless economy. So Ethereum takes the base layer of Bitcoin a step further and is thinking about more than being the base layer for a digital store of value and thinking about the utility of the internet and how you can have an entire decentralized economy. So, some of the things that Professor McGinnis touched on are the limited utility of the Bitcoin network today. And so when you look at something like Ethereum, that's where you're starting to see tools come online that parallel the offerings that we see in traditional banking today. So it's really more disruptive than Bitcoin in the DeFi movement because we're taking things a step further and functioning in an entire decentralized economy, not simply a decentralized store of value, but rather an entire decentralized banking system where the tools that you need to conduct day-to-day activities are now also online in a decentralized fashion. A little bit about Ethereum's narratives to parallel Bitcoin's narratives. Similar to Bitcoin, Ethereum has also had a lot of narratives. And the fact that it's had a half dozen narratives in its, 6 years of existence now, contributes to the confusion around what Ethereum is. Ethereum started as a Bitcoin 2.0, and now what we're really seeing Ethereum as today is the base layer of DeFi. So something that started as a project to improve upon the limitations of Bitcoin, fast forward 6 or 7 years, now Ethereum's really found its lane as the base layer for DeFi and decentralized finance. A little bit more detail about DeFi. In the upper left-hand corner, you can see a snapshot of the total value locked up in DeFi. So in terms of valuation, you look at Ethereum approaching $300 billion in valuation and market cap. About 10% of that is locked up in DeFi. And so DeFi, much like the digital asset space, is exploding in adoption and popularity. And we see a bubble forming around the popularity of DeFi, much like in 2017, we saw a bubble developing around Bitcoin itself. Let's shift gears again. So we've talked about Bitcoin, we've talked about Ethereum, but there's thousands of other cryptocurrencies. So altcoins are alternative cryptocurrencies. The traditional approach, as a purist, you'd say that an altcoin is anything but Bitcoin. But a more nuanced approach, especially with the maturity of Ethereum, would be to talk about Bitcoin, Ethereum, altcoins, and stablecoins. Chainlink, Polkadot, Cardano, Tezos, Monero, and Litecoin are all unique altcoins that we'd like to highlight. They're all performed very favorably in our core rating framework at CryptoEQ, which is part of our fundamental research that we do. Chainlink is more of an oracle, and its mission is to help bridge the gap between traditional legacy data and information and help make blockchains and the new world of blockchains more useful. So a lot of these blockchains are coming online, these altcoins are coming online, but they're in a silo as far as traditional data is concerned. So Chainlink exists to help connect and bridge the gap between the legacy finance, legacy traditional system, and port that information over to these new blockchains that are coming online. Polkadot and Cardano and Tezos, you can all think of as playing in the general purpose smart contracts bucket of digital assets. They're very similar to Ethereum, and they do consume and take some of Ethereum's market share. Monero is a different project altogether. Monero is probably the strongest privacy oriented cryptocurrency. We've rated it favorably in our framework, and that is really the go-to for people that value anonymity above all else and value transacting in an anonymous fashion. Litecoin is another asset we'd like to highlight. We really think of Litecoin as the silver to Bitcoin's gold. When Professor McGinnis mentioned some of the limitations in throughput and transaction speed on the Bitcoin network, Litecoin is a faster architecture. It's got different aspects to its architecture and algorithm that helps speed up transactions and throughput. And so you can think of Litecoin as a faster Bitcoin or a Bitcoin Lite, a silver to Bitcoin's gold. Something I really like to take a few minutes to speak about are stable coins. So one of the limitations that Professor McGinnis touched on is the volatility of the crypto market. And at an average 200% return over the past decade, when you annualize Bitcoin's returns, that is incredibly volatile. So if you look past a digital store of value use case in Bitcoin, and you start to think about how you can live day to day, you really need to start thinking about stable coins. The most popular stable coins are USDC or USD coin, which is pegged to the US dollar, meaning that one USDC roughly is valued at the $1 US. WBTC and Bitcoin are another example of a stable coin pair. That's a wrapped Bitcoin or a Bitcoin stable coin that exists on the Ethereum blockchain. So that's an example of adding more utility to what Bitcoin is. You can wrap your Bitcoin and use it in the Ethereum ecosystem and start using DeFi products with your wrapped Bitcoin. The last example I'd like to give for stablecoins would be PXG, Pax Gold, which is a stablecoin that's pegged to the spot price of gold, physical gold. So that's another example of a digital store value, but you're trading in your Bitcoin there as an example. You're using a digital asset that's pegged to the value of gold. The most popular stablecoins today by market cap are Tether, USD Coin, and DAI. So all three of these are pegged to the US dollar and collectively represent a majority of the stablecoin market. And keep in mind that stablecoins are about 5% of the entire digital asset ecosystem by market cap. Now, if all of this was useful to you and informative, there's lots more at our website, cryptoeq.io. We do strive to provide industry-leading research and market insights. Our ratings and signals accelerate your investing and trading success. We are Rice alumni owned and operated. And if you sign up today, you can take $10 off with the promo code RICE. That's capital R-I-C-E. If you'd like to stay in touch, we're active on all social media platforms. That's at CryptoEQ. And if you'd like to reach the team directly, you can email us at team@cryptoeq.io. Thank you very much for your time. I look forward to the moderated Q&A.
Great, thank you for that overview. Next up and final panelist, we have Ms. Petal Walker. Go ahead.
Great, thank you so much. And thank you for inviting me to speak tonight. I have to apologize in advance. I have a 9:30 cutoff, so I will be exiting at that time. I'm just gonna speak very briefly just to open things up about policy and regulation around cryptocurrencies. I think it's important for someone who's not familiar with the regulation to understand that for coins, there isn't a coherent regulatory structure for coins. We have the financial regulatory system, and that's really defined by function, right? So as we know, if you have an entity that takes deposits and lends, then we treat that as a bank. If we have an entity or we have some sort of entity or individual that they're discussing some sort of investment and they're talking about how much money you'll make from the investment, then we treat that as security. So we have a financial structure that's in place, and digital coins are pretty much splashed onto that structure. And so if the coin or the operator of the coin or the way in which it's used resembles a bank, then it'll be treated as such, and it'll fall under that regulatory scheme. The same for security, the same for commodity. And so I think it's just helpful to think about that, because often I find when speaking to audiences that they're confused, that there isn't a clean explanation of how digital coins are treated regulatorily. But it really depends on, it depends on where the coin lands within that overall structure. And so just as an opening, I'd like to say that. The second thing to think about when we think about the regulation of coins is that there are really two big questions. Number one, how is the coin defined, right? What is it defined as? And then number two, how is the actor using the coin, and therefore how is the actor defined? So the regulation follows those two questions. How is the coin itself defined, right? And so there are a number of ways that a coin can be defined. The coins that have been discussed tonight are generally considered commodities because they are a medium of exchange, they are a storehouse of value, they're operating on functioning networks. There is, they are most like money in that way. And so they would fall under broadly the commodity definition. And if we're dealing with coins that are being transferred in, quickly and actually delivered, then they're going to be a cash commodity. And as such, the regulation will generally be under the CFTC, the Commodity Futures Trading Commission, my former agency. The regulation there would be for anti-manipulation, anti-fraud. So if you're just in a cash market, which is the least regulated market from the CFTC perspective, then the CFTC will really just focus on false claims, basically, statements about the coin that are inaccurate. And so you see several cases that deal with just fraudulent statements about a coin, because those coins are defined as commodities, they're being exchanged in a cash market. And so the regulation is relatively light from the CFTC perspective. But then you have this whole FinCEN arm, right? So if there's any entity that's holding accounts in which they have the coins, if you're a money transmitter, meaning that you're pretty much the exchange, then you're going to have FinCEN obligations. And that's the recent rule that we may discuss later. You also have state requirements. If you're, they have money transmitter licenses. And so you're going to have state requirements, you're going to have FinCEN, you're going to have the CFTC, just for that kind of light anti-manipulation, anti-fraud oversight. But if the coin itself is defined as something more robust, right? So the coin is a security. And this is this distinction between the commodity and security coin is the most critical. If the coin is a security, and that determination is a tricky one. For the most part, coins are considered securities when there's a common enterprise. You have a group of individuals who are going to make money off of this coin, but there are certain individuals that have more information than others, right? It's the classic image of the security in which there's someone selling a product and the person who's selling it knows the information about it. They have to disclose that information to those they're selling it to. And there's this informational asymmetry. The people who are buying the product are relying on the efforts of the individuals who are selling or whatever. And so if a coin looks as though, or if it's marketed as a security, it can be defined as such. At the same time, if you have a coin, on the other hand, if you have a coin where people generally understand what it is, right? It's not as if there's some sort of some material amount of information that certain individuals have versus others. This coin is functioning, as a medium of exchange somewhere on a network. It's not just some kind of idea that's being sold. Then that coin will be defined as a commodity, and or should be defined as a commodity. And the regulation is very, very different. So that's usually the first question when I have a client and they have a digital token, is first defining what it is. And then, we can take it to higher levels of the commodity. It could be a swap, it could be a future, it could be a forward. And so that question of definition of the product is really the first step in the analysis, at least on the regulatory side. The second question then is the entity that's before me, right? How are they using the coin? So if you're just a straight commodity, you're a Bitcoin, you're a Litecoin, and you have, and you're doing cash transactions, then the entity that executes transactions doesn't have to register with the CFTC, rather have the money transit state requirements or have the FinCEN requirements. They don't have to register. The intermediaries don't have to register. But if you're considered a swap or you're considered a future product, then all of that changes. So any entity that executes transactions would have to register, the intermediary, so on and so forth. So when you think about the regulatory scheme, just generally speaking, the two big questions really are, how will the coin be defined and how are you using it? And something could be called a digital token, but it can be seen as being very different based on how it operates. And that difference will then create a very, very different treatment and more or less regulatory burden. So hopefully this kind of lays out the general sense of how the regulatory scheme works currently for digital tokens, and happy to dig in further in our discussion.
Sure. Thank you so much for those remarks. They were very helpful, and frankly, it's a perspective that I don't think we get very often, that of a former member of a regulatory body that deals with these things on a pretty regular basis. So one of the first things that I wanted to call out before we move into the moderated discussion is just to make sure that everyone knows in the audience that you can be posing questions as we move through this discussion that we will read out for the Q&A. You'll also have the opportunity to raise your hand and ask the question yourself during the Q&A session, but just wanted to call out the Q&A function before we move into the moderated discussion. So I guess the first question that I had right off the bat was, I guess deals with something that Professor McGinnis brought up, and that's that Bitcoin and potentially other cryptos are serious rivals to fiat currencies in the sense that it challenges a strong instrument of the state's power, and that this challenge is stronger in comparison when there are weaker currencies and weaker regimes in general that oversee these currencies. He also mentioned that the likelihood of these, cryptos and Bitcoin specifically in this case, actually challenging these fiat currencies and these states fairly applying the legislation that governs these currencies is less likely in, again, weaker, more coercive regimes. So to all three of you, I wanted to pose the question, if you could speak a little bit to this paradox and what you see is kind of the main point of tension here. And if you think that there is any way to break through this tension in a way that we could see potentially a state like Venezuela, for example, adopting Bitcoin as, almost a rival to its central currencies, how would we see that playing out and becoming a reality?
We won't. I'll just jump in. We won't see it adopting it in some sense. It's a rival, which precisely Bitcoin flourishes there because it's such a bad state currency. But I see, as it maybe just be a little clear in what I see and connected up with one thing Mr. Randall said. So one can think of where Bitcoin can be. It can be a competitor against really bad currencies, or, and Mr. Randall suggests, it's going to even now rival gold. It rivals gold. I believe the market cap of gold is something like 14, 17 trillion dollars. That's a lot of room to grow for that. But gold is still more volatile than most currencies. People don't hold their money in gold. So the question is, can it even grow? Can it gain market share over that? And of course, you can array currencies along a spectrum in the world. So even it beats Venezuela. There are BRIC currencies that are more volatile than US currencies. BRIC, I'm sorry, I'm using a term for some developing nations, Brazil, I can't go over all, Indonesia. They're better currencies than Venezuela, but they're not good as the dollar. Can it become competitive to them? Again, it becomes competitive, it gains strength. And that's my imagination, at least, for how cryptocurrency could climb various rungs and ultimately continuing to gain market share, and then ultimately, of course, it turns around and challenges the dollar and the euro. That's the imagination. It's never that one of these bad regimes, I think, is going to adopt it because it's that they, oddly enough, give it life, as it were, because of they're really terrible, and people therefore want to use cryptocurrency despite its volatility, because of course the Venezuelan peso is pretty volatile as well.
I think I would just add to that. I think in terms of having an effective, stable, promising digital currency, a couple things keep in mind. One, I think Professor McGinnis mentioned this earlier, the derivatives markets are seen as a potential way to help to stabilize this. We currently have exchanges that have futures on derivatives, really hoping that this would be a means to stabilize and to hedge, have price discovery. And so that very well may be helpful in doing that. They've had historically relatively low volumes, but they're increasing. I have a lot of institutional clients that are just becoming much more interested in a Bitcoin. So these kinds of products could be very helpful. I think the ETF also mentioned would be a great way to help to give individuals access to these products. But it's interesting, one thing that I've thought about that no one seems to be interested in doing, but I think makes the most sense, in terms of helping to get an ETF-like effect without having ETF, is really to focus on the commodities laws, because the CFTC is much more friendly and open to cryptocurrencies in the end. I shouldn't say that, that's probably one thing. The CFTC has had rules that are much more, I would say, flexible and forward-thinking about cryptocurrencies. And so I've often thought, why not just create an index of cryptocurrencies based on these exchanges that are out there, and then put on a CFTC regulated product, like a futures or swap on top of that. That would be a way to allow investors to get access to a broad range of currencies that could really help to stabilize the market. But nonetheless, just thinking through now, of course, we also have these CBDCs, right, which are actually digital dollars from the different entities, which are, different nations. And there's a lot of interest potentially in that. I think the average consumer really doesn't care. They really want something that they can rely on, they can get to quickly, and it's really about speed and efficiency. So I do think that, and the stable coin, there's so much interest in stable coins because of that idea that they're going to be able to peg it to something that's quote unquote predictable. So just want to throw that in there, and that there are competitors to Bitcoin and these other cryptocurrencies potentially having this prominent role. And it'll be interesting to see as nations start to roll out more of their CBDCs that they have a great uptake, and those become much more popular.
Jacob, with the way you framed the question, I really think that you're getting at, what can mass adoption look like global scale? And so to that, I'd like to talk about a few key metrics. I lived and breathed crypto markets when it was tens of billions of dollars and not, several trillion. So I've seen a lot of growth firsthand. To the point about the comparison to digital gold and gold's market cap, from here, Bitcoin needs a 10x to achieve gold's market cap. When we look at the repeatable, predictable cycles of Bitcoin, that can happen within the next cycle. So potentially by 2025, we could be looking at a $10 trillion market cap in Bitcoin. So from someone that's seen it, 100x, I think that's very attainable. It is the most secure network in the world. It's never been hacked. It's provably secure for 10 years. We don't see any reason why we shouldn't have Bitcoin sustain itself for another decade. It's performed incredibly well through the first decade as a digital store value. The second point I'd like to make would be about, well, what does mass adoption look like and what kind of metrics can we use to benchmark there? If you look at the two, biggest household names as far as centralized crypto exchanges, you have Binance on the global stage and you have Coinbase on the US stage. And if you look at Coinbase, it's got about 50 million users. And if you look at Binance, it's got over 100 million users. So we're looking at potentially hundreds of millions of verified users of centralized crypto exchanges. So if we just want to lowball the adoption there, we're talking about hundreds of millions of people, individuals that are using crypto exchanges. So at what point do we start to consider that crypto is being mass adopted? Is it 1 billion people? I mean, do we need to see a 10x in users as well? And keep in mind, this data doesn't speak to the unbanked and the decentralized DeFi movement and the use of DeFi products, which wouldn't necessarily be pegged to something like a centralized exchange, which rather need to be measured by wallet addresses. And then the last point I'd like to make is, what do I personally think mass adoption looks like? So the greatest utility of crypto today for me is as a digital store of value and as a medium exchange. And so I'm able to live entirely off of the crypto ecosystem, and I don't have to use traditional banking systems. And I do that by tools that are being brought online by some of the brilliant minds that are flocking to the crypto industry to build solutions for crypto. So I'm able to use a debit card that's a Visa product to transact and live off of, and it's entirely powered by crypto assets. And for that, I use a mix of things like Bitcoin, Ethereum, and stablecoins. But this is all compliant. I'm KYC, AML, the whole 9 yards. I'm a US citizen living in Texas. And I'm able to do all of this with some of the tools that have come online. And so my point is that mass adoption to me looks like companies building solutions to make crypto easier to use, as I completely agree with some of McGinnis's opening remarks about how difficult Bitcoin can be to wrap your head around and use. And so there's companies coming online to shorten that learning curve and build tools that we're more comfortable with. So I think mass adoption looks like using crypto without knowing it, using a Visa card that's powered by crypto assets, and you don't know that the back end is driven by crypto, but it is. And the businesses choose it because it's faster, it's less friction, more cost effective. It's better for their bottom line. It's better for the world.
Sure. Thank you all for those responses. And I guess piggybacking a bit off of Ms. Walker's response and Mr. Randall's response as well. Ms. Walker, you almost offered an alternative to some of these, to Bitcoin, for example, as the main challenger. And Mr. Randall, in your talk, you talked about Litecoin as kind of the silver to Bitcoin's gold, and it almost sounded like it was a more efficient version of Bitcoin in terms of the transaction speed. So you guys all, Mr. Professor McGinnis as well, spoke to Bitcoin. Some of its power is it was really the first mover. So as these cryptocurrencies like Litecoin start coming online, they may be, just better versions of pre-existing coins. Will coins like Bitcoin always maintain that advantage as the first mover? Which ones are most poised, I guess, to undo that advantage as Bitcoin's first mover? And is there a possibility for potentially multiple coins to be presenting a viable, realistic challenge to fiat currencies, or does it mainly have to be kind of concentrating on one coin versus the other, especially from a regulatory standpoint?
So my image, so Bitcoin does have first mover advantage, as also Mr. Randall says, the most decentralized. That's the place I would put my most assets in now. But my vision is here's my vision, and it really is a vision. My vision would be also would be that we're going to have a wide variety of kinds of cryptocurrencies. So one of the interesting things about cryptocurrencies is that they can be specialized. They can have uses. In fact, we haven't even talked about tokens that may have very specialized uses, and they may work better for this. So we talked a bit about, Mr. Randall talked about Litecoin, which is much faster than Bitcoin. And Bitcoin isn't really very great for transacting, going and buying things at the moment. It's not, as I understand it, it's not so good. So here's what we're going to happen. We're going to keep most of one's sort of long-term assets in Bitcoin, and have structures where, we'll just switch some into Litecoin to do the transactions. So my view, and my next article I've been sort of joking about writing is this. A Bitcoin, the cryptocurrency to rule them all. So, right, you have a lot of these different, the equivalent of rings that have these different focuses, and we have a kind of ecosystem of cryptocurrency, and you'll see them quoted in various places, but they're going to have these somewhat different functions. But I do think Bitcoin has both the first mover advantage and at least at the moment, the most decentralized system that, at least in my view, suggests that it is going to be still at the heart of the cryptocurrency group for the foreseeable future.
I'll build on Professor McGinnis's remarks. When I fast forward and I think about, okay, how many projects do we see mattering in the next 5 to 10 years, or how many crypto assets will be around in the future? We'll break it down by use case and kind of create buckets of how we use these different digital assets. So Bitcoin is the first mover, longest standing. We've got over a decade of price action to review and a decade of history, it's really closed the door on the digital store value use case, in our opinion. We see that Bitcoin's found the strongest narrative in the crypto ecosystem as a digital store value and digital gold. So I don't see any real competition on that use case. I think Bitcoin over the next 5 years will continue to prove to be the best digital store value in digital gold. Where I think it gets more interesting is when you look at other use cases. So when you look at Ethereum as the second mover to Bitcoin and its general purpose smart contracts, that's where I think there's a lot more competitive aspects to that and a lot more competition to consider. You've got different projects competing in market share. You've got things like BNB and Binance Coin and the Binance Smart eating up a lot of Ethereum's market share today. With Ethereum at a $250 billion market cap, Binance has quickly developed a solution to absorb about a third in 90 to 100 million, sorry, 100 billion in market cap. And there's a lot of other competitors as well to consider there. So I think that's a much more competitive use case that we need to see play itself out. But looking at all the different use cases, the theme that I see, my personal opinion, is that you'll have market leaders by each use case, much like you have in the equities markets, and you'll have a lot of competition. But at the end of the day, at the end of the decade, we're probably looking at 1 to 2 clear market leaders per use case, with the other thousands of cryptocurrencies essentially going to zero or not really having any utility. So that's why we're very careful about what we analyze and list at cryptoeq.io, because if we're listing it, we think it matters. And that's why we only list about 30 assets today in terms of our research, going on 50 assets. So, my quick one-liner would be, we see dozens of crypto assets mattering in the long term with thousands of competitors and speculative opportunities. But really, I think there's a few dozen digital assets that will have staying power.
So if I might just, Mr. Randall, you said something very interesting. So you agree that there are going to be these different functions that certain cryptocurrencies will be specialized in functions. But what you also say is very interesting is that there's going to be a clear leader. And so unlike, and once you're a leader, there'll be no reason to use something else. So at least in these other areas, it's quite speculative to invest in them because it's unclear who's going to win out. Maybe Bitcoin is a little less so because we're relatively more confident that it's going to be the kind of long-term value cryptocurrencies. Would that be a fair way of characterizing your remarks?
Yes, I would say that when you look past the digital store value use case, it's still very early. So if you look at Ethereum as the second mover, its product is not in its final form. We're still talking about ETH2 and its roadmap. It looks like we're about halfway through that roadmap. But for Ethereum to realize its vision as a base layer of DeFi, we still need about another year for them to deploy that roadmap. So some of these things that we're talking about that are the future of DeFi are still very early and still very much unfinished.
Great. Thank you both. Thank you both for those answers. It really paints a compelling picture of kind of an ecosystem of currencies, each, kind of with their own functions and so on and so forth. I'd like to go ahead and open it up to the audience for Q&A. It looks like we have Anson Fung, who's actually a former president of the FedSoc himself. So I'll go ahead and unlock your microphone. So go ahead and ask your question, Anson.
All right, can you guys hear? All right, excellent. Yeah, thanks for the intro, Jacob. I'm always glad to be back at a Rice FedSoc event. My question is about the potential implications of Bitcoin and or blockchain in general with the First Amendment. I think recently I've read some articles about potential First Amendment issues coming up with blockchain as code. I'm just wondering if you had any thoughts on a potential framework to think about blockchain and First Amendment questions, especially with the non-currency transaction functions of blockchain. Thanks.
Well, so I guess this is I'm a law professor who teaches constitutional law, so I guess I should take this, although I'm first going to say that I'm not very familiar with this issue. I would be skeptical that ultimately the court would simply say, I understand the argument that because this is an expression through various code, that we're going to start dealing and giving First Amendment protections to currency, if that's the implication of the question. Maybe it's not. I think some people have worried, in fact, that the First Amendment, which is all about expression of persons to person, will be transformed into a general deregulatory mechanism as everything is put into code, and therefore one can understand it as expression, although its real function is not what traditionally First Amendment is about, a speech. So if that's the question, I think ultimately the courts are going to be resistant to giving First Amendment protections to cryptocurrency, to blockchain, or simply on the theory that these are codes. They're going to focus on the functions of those rather than the symbol-like basis.
I talk to people about crypto all day, all week. I've never gotten that question before, so it's an interesting question. I want to limit my input to where I really am an expert. So I'll just comment in jest that Bitcoin can often feel like a religion. So I can't weigh in really on whether or not I think that there'll be First Amendment conversations here. Just there's very strong fervor around each digital asset, especially Bitcoin, and it does start to feel like a religion at times. So I'd like to say that when it comes to crypto, I'm agnostic and I evaluate and I'm objective about all digital assets. But I do happen to have a significant allocation to Bitcoin.
Well, I think you're saying about religion is very interesting. I mean, I think our world is fragmented into various kinds of identities, and one interesting aspect is some people actually so much identify with the crypto movement. It's also, I think, moved. It's one of the examples of, I think, libertarianism generally moving from ideas about reforming government to actually ideas of creating projects that may be alternatives to government. So I do think it has these very interesting social aspects as well as the kind of economic aspects that we've been talking about.
I agree. I think that true autonomy and freedom is not complete without financial autonomy. And so the Bitcoin network does provide opportunities to have financial autonomy.
Great. Thank you, Anson, for that question, and to you both for your answer. We've got another question from Spencer Moffett. Spencer, go ahead.
Hi, can you hear me? Great. Thank you both to both panelists. This has been a very edifying discussion. My first question was for Mr. Randall. There seems to have been a sort of an incorrect labeling of the cryptocurrency industry as a potential safe haven for illicit activity. Janet Yellen, the former chair of the Federal Reserve, has remarked about this, and others have said things similar. But only about 2% of all financial transactions that occur over the blockchain through a variety of different cryptocurrencies are actually considered illicit or illegal. So I wanted to ask Mr. Randall, why do you think this is? Why is the volume of illicit transactions so small in comparison to other financial markets? And then my second question is for Professor McGinnis. And my question is, do you think we will eventually reach the stage where people are talking about how much their dollar is equal to in other cryptocurrencies, as opposed to us talking about how much a specific Bitcoin or a specific piece of Ethereum or whatever cryptocurrency we're referring to is worth in dollars? Do you think it will eventually become so mainstream that does become the case? And I obviously don't think that this will be somewhat soon, but do you think this could happen in my lifetime of someone who is college aged? Thank you.
So Jacob, I'll take the first part of the question. It's great to connect with another Spencer. So to the point about nefarious activity and illegal and illicit activity, when public figures come out and talk about Bitcoin being used disproportionately for illegal activities, generally we see them walk back their statements, and Yellen did that as well. When she came out, a few weeks prior to some of walking back her statements, that she said that Bitcoin's used for illicit activities, and then 2 weeks later she walked it back. So I would say to that everyone's on their own crypto journey, and that generally the more they learn about crypto, the more they'll start to see that the data shows that it's not disproportionately used for illegal and illicit activities. I would say that criminals, it would behoove criminals to use cash and fiat as opposed to something like Bitcoin, because Bitcoin can be traced. And just like you have companies building infrastructure, like CryptoEQ building infrastructure for crypto and to help people learn about crypto, you've got companies building solutions to trace all kinds of blockchains, Bitcoin being one of them. So there's software that's deployed and it's used by governments to trace Bitcoin and its transactions. So I wouldn't recommend Bitcoin be used for criminal activity at all. I think that illicit activity is probably more common in fiat and cash because physical cash is harder to trace and track. So that's kind of my two answers to public figures speaking out against Bitcoin and Bitcoin being used for illicit activities, and the actual technology of Bitcoin.
So I am a long-term optimist and think it's possible that we'll be talking more about values of dollars and Bitcoins the other way around. I mean, one thing we haven't talked about is one reason I think is just generational. So I think one reason is, of course, ultimately, as I suggested, any confidence in currency is based in trust. So for people who are older, of course, I'm a bit older than everyone else on this call, cryptocurrency seems very strange. But I think it seems much less strange to a generation that moves from screen to screen. And so that basic social fact, I think, is another thing that is going to get greater acceptance of it. So I would be a long-term bull on it. I just don't have the basis that Mr. Randall has for predicting any particular price point. But I think it's a great mistake. And here is, I will give some investment advice. I think it's a mistake for people not to have at least 1% of their net assets in cryptocurrency.
Great. Thanks for that question and for the answers, of course. I've got a question that Franklin Briones typed into the Q&A chat that I'll go ahead and read. With the rise of NFTs and putting ownership of items in a ledger, is it possible that in the future tangible items can be listed on the ledger? Let's say a house could be on the ledger or some other similar item or asset.
Yes, tokenization of all physical things is a trend now. There's blockchain projects designed and built specifically for real estate. They happen to be more common on the Tezos blockchain. It seems that Tezos has found a real narrative there with partnering with real estate companies. So yes, I would say that the theme of NFTs can extend to not only art, but the tokenization of physical assets in general.
I think so. I mean, there are two uses that I can think of this. One is actually use it as a recording device to actually make clear who owns various real estate, so a one-to-one thing in the physical world. Another thing is creating more value. So one idea I've had, one idea you might think of for even a company would be something that would take people who have existing valuable art and make sort of NFTs, 10 NFTs of them, sort of the equivalent of prints. And that would give a certain scarcity to people who might not be able to own the actual art, but could have the NFT version of it in scarcity. So I think we're going to see a lot of things around that. It's extraordinary what's happened in NFTs. It's another thing that makes me think that crypto is here to stay, because what's happening is we're seeing that this idea of cryptocurrency is spawning off things that really aren't efforts at currency, but are just other kinds of crypto assets. And that strikes me as very, again, very bullish for the long time of the cryptocurrency that we have sort of allied assets beginning. It's really catching fire. That's just my impression sociologically.
I'd like to illustrate Professor McGinnis's point. So the shirt that I'm wearing is wearable art. We partnered with one of the first women crypto artists to produce any art on the Bitcoin series, the Bitcoin conference series. So not only does she produce wearable art and she takes her paintings and turns them into apparel, but also she produces limited edition NFTs, to Professor McGinnis's point, where there's only so many of these digital prints, and you can own the asset on a blockchain and even bid on the asset in live auctions. So this CryptoEQ art can exist on a blockchain in perpetuity.
Great. Thanks again, Franklin, for the question and for your answers again, Professor McGinnis and Mr. Randall. I've got another question from Prad Biswas. Prad, I'm going to go ahead and open your microphone, so go ahead.
Hey guys, can you guys hear me? Okay, sounds good. So I had a question regarding, I guess, like SEC regulation within crypto. Specifically, I know in the past, there's been Ponzi schemes like with BitConnect, there's been pump and dump schemes. There's all kinds of fraudulent schemes that tend to happen in the crypto world. And I guess my question is there a regulatory framework within the SEC to protect investors from these schemes? And if not, is there going to be one developed anytime soon?
Well, Ms. Walker would be the perfect person to address that more fully. But let me say this, that insofar, most of what Mr. Randall and I have been discussing really are used as commodities. That's not the question. I think you're really talking more about tokens, which are understood as securities. They meet something called the Howey test in securities law. And what the SEC is trying to do is to regulate them as securities. And so they're really quite substantial regulations of initial public offerings. And if these tokens are counted as initial public offering, they have to go through a substantial requirements of disclosure to militate against the kind of concerns that you've expressed. And it's only kind of recently the SEC, I think, has formalized and put in stone the idea that all these utility tokens are going to be dealt with as securities. And I think, as I understand, I had a student who wrote a paper about this term, it has substantially decreased the amount of fraud in the US jurisdiction. Of course, some of them have moved to other jurisdictions in the world.
When we see the SEC come down on a project like BitConnect or another scam, I see it as something as healthy because it gives us precedent. I mean, it's very, very early. It's very early in the crypto innings, right? This is 10 years in existence. It's only 10 years old. So we're seeing it grow up. I like to see precedent. I like things like BitConnect being brought to justice. I like seeing scams, de-risk the industry and discourage nefarious activity in general. I would also comment that we've seen leaders at the SEC weigh in and say that Bitcoin and Ethereum are not securities. It's not formal, but they are commenting, either past or present leadership of the SEC commenting that Bitcoin and Ethereum, because of their decentralized nature, are not securities, whereas something like XRP is currently, it currently is in a lawsuit with the SEC. We could speculate on how that's turning and how that will play out, but these lawsuits and these comments give us precedent, which is incredibly important when we think about the future of the industry.
Great. No, that makes a lot of sense. We have another question, this time from Dylan Glenn. Dylan, I'll go ahead and open your microphone up. Go ahead when you're ready.
Great, I'll trust you all can hear me. I have a somewhat tangential question as to the relationship of cryptocurrency to energy and environmental concerns. Crypto mining is already shown to consume very large amounts of energy with the corresponding environmental impact, at least at the current time. So I guess for Mr. Randall, are there any efforts to address energy consumption problem as cryptos scale and become more popular? And for Professor McGinnis, does environmental regulation possibly offer an inroads for increased government regulation of cryptocurrencies?
Thank you for the question, Dylan. I'll kick it off. So energy consumption is a very popular topic with crypto. And there's a couple points I'd like to make. We know and have friends of CryptoEQ that operate mining companies. And I'll say that the mining industry is very, very tough industry, especially in down cycles of the crypto markets. And so as a miner at scale, you can't operate unless you're sourcing power very cheaply. And in order to source power very cheaply, you need to be utilizing renewable energy. So would they focus on locating their mining operations, and I'm speaking anecdotally through a friend's company, they focus on operating their mining operations via renewable energy. So being one of the obviously cleanest ways that you could consume power. And then the second point I'd like to make is often people look at Bitcoin and the crypto asset industry as an add-on or something extra that's complementing traditional institutions in the banking industry. Bitcoin and its counterparts are incredibly disruptive and can replace existing infrastructure. So I'd like you to frame it and think about the energy question in terms of replacing what already exists with increased efficiency. So if you think about the energy consumption of the entire banking system and all of the intermediaries needed and steps needed to conduct globally, right? That energy consumption, it's massive. And when you look at the Bitcoin network as something that could potentially replace some of that infrastructure more efficiently with less intermediaries, with less counterparties, I think that you might start to think about the energy question a little bit differently.
So I just had 2 points to this. One is the miners will go to where energy is extremely inexpensive, and sometimes that actually means that the energy would be just being wasted otherwise. And so it's not obvious that there's a substantial extra cost to the environment. The other point I would make is absolutely that miners should have to pay, or if we had something sensible like a carbon tax, they should pay the tax that everyone else has to pay for energy to equalize that with the externalities that that any kind of energy consumption creates. But I don't see this as a special, at least unless government has special rules, and I don't think it should have special rules to regulate the use of energy by cryptocurrency more highly than any other kind of use. So I don't see it as a special way of inroads of government, so long as government does what I think it should do, regulate and impose costs on all energy users neutrally.
Great, thank you.
Jacob,
Sorry.
Context.
If you'd like to add on, go for it.
That's McGinnis's point. To the point about burning off waste. So another friend operates a mining company that deploys Bitcoin miner and mining rigs in the form of intermodal shipping containers on site to natural gas resources, where on site they burn off and flare off the waste to capture value from the waste product. So in that case, we're not even talking about burning off valuable resources and natural resources, but waste, things would otherwise be disposed of. So I don't view that as reliable as a renewable energy or as making up as much of the mining industry's energy usage. But it's a fair point from Professor McGinnis. We're just recapturing waste at that point for the mining industry.
Well, great. Thank you very much to both of you for your answers, and to Dylan for your question. Unfortunately, I think we're pressing up on our time limit here. So I'm going to go ahead and close out the event by saying thank you again to everyone in the audience, and especially to everyone who posted questions for attending and for your interest in the event. Of course, if you guys have any further questions or would like to keep in touch with anyone in specific, go ahead and shoot me an email. I'll go ahead and put my contact information in the chat, and we'll see what we can do. I want to reiterate that there is the $10 promo code RICE with the capital R. If you'd like to go and check out cryptoeq.io and see some of the membership packages they offer, yeah, that's a pretty good deal there. So To the panelists again, thank you very much for your time and for working with us here at the Rice Federalist Society.
Well, thank you very much. I enjoyed it.
Enjoy the conversation. Thank you.